There's a certain limit of exhaustion that the Bitcoin market reaches before it inevitably turns around. And what's interesting is that the reason for that reversal is actually much simpler than most people think. So in today's video, I want to explore exactly what that limit is, how we can objectively measure it, and why it gives us one of the cleanest ways to estimate how long negative price action is likely to persist. So let's get into it. Right now, Bitcoin is still trying to reclaim its three main pricing levels. These are the 365-day moving average, the 200-day moving average, and the short-term holder realized price. And at the moment, it's not looking great. We've seen price reject from all three of these key levels, which tells us that the market is still definitely under pressure and confidence hasn't fully returned yet. But today, I don't want to focus on all three. I want to zoom in on just one of these levels because historically it's provided one of the most reliable and surprisingly simple ways to determine how long periods of negative price action tend to last. And more importantly, it helps us understand when the market is genuinely getting exhausted. So what we're looking at here is an indicator called the days spent in loss. And this is a sentiment-driven indicator that tells us the duration of market stress for Bitcoin's most sensitive cohort, which are the short-term holders. Now, this indicator tracks the number of consecutive days that the Bitcoin market price has remained below the short-term holder realized price. And that realized price represents the average acquisition cost for coins that have moved within the past 155 days or less. Or in other words, it's the average price paid by newer market participants over roughly the last 5 months. And that's critical because short-term holders are the most reactive participants in the entire market. They're the ones most likely to panic, most likely to sell into weakness, and definitely most likely to give up when things don't immediately go their way. So when Bitcoin trades below their average acquisition cost, that cohort is underwater and psychologically stressed, and then they become increasingly impatient. So what this indicator here is effectively measuring is whether the Bitcoin market has any real interest from these newer entrants. But more on that, it acts kind of like a psychological patience test. It tells us how long the new market participants are willing to endure pain before they eventually capitulate and exit their positions. Now, we already know that Bitcoin's price can stay well below this average acquisition cost for extended periods of time. That's not new. But what's fascinating is that the patterns that emerge during these periods are remarkably consistent across all the market cycles. Eventually, the market reaches a point where selling pressure simply runs out, and the sellers become exhausted. The short-term holders who are going to sell have already sold at this point, and once that happens, it doesn't take much demand at all to push the price higher. And that's why human psychology is so fascinating. The market evolves, sure, but the human brain certainly doesn't. Now, as we know, one of the simplest yet most powerful ways to determine whether we're in a local Bitcoin bull or bear market is by whether price is below or above the short-term holder realized price. And on the chart here, this is plotted as the green line overlaid on the price. And currently, that short-term holder realized price sits at around $98,000. That means for the average person who's bought Bitcoin over the past 5 months, this is likely going to be their average cost basis. And right now, price is firmly below it. And the days spent in loss indicator simply counts how many days we've spent consecutively below that level. The colours on this indicator tell an important story. The purple and blue colours represent periods where we've only spent a small number of days below the short-term holder realised price. And these are the early signs of distress. They tend to show up during minor pullbacks or brief periods of uncertainty. But as the colours shift into brighter yellows and eventually into reds, what we're seeing is a prolonged time spent below the short-term holder cost basis. These are the periods of significant stress, and these are the moments where short-term holders are deeply underwater and confidence is shattered. And at this point, capitulation tends to take hold. And historically, these brighter yellow and red regions have marked the periods of pure capitulation at the deepest phases of the bear market. And what this tells us is fairly straightforward. The longer these bars grow, meaning the more time we spent below this cost basis, the higher the probability that short-term speculators have been flushed out of the market entirely. Every additional day below this level increases the likelihood that the weak hands are gone, and as this selling pressure diminishes, the probability of a reversal rises. And what's remarkable here is how consistent this behaviour has been at every major cycle lows. When we look back at the previous bear markets, the data lines up with almost uncomfortable precision. Each of the previous 3 Bitcoin bear markets has eclipsed a very similar number of days below this realised price before finally marking a bottom and beginning a sustained rally higher. In 2015, Bitcoin spent 208 days below the short-term holder cost basis. In 2019, it spent 203 days, and in 2022, it spent 210 days. So across 3 entirely different market environments, with different macro conditions, different narratives, and different participants, the market bottomed within roughly a week of the same duration of short-term holder pain. And that's an extraordinary level of consistency. And it's an interesting way to view the market because it aligns perfectly with the idea of mean reversion. Markets don't move in straight lines forever, as we know. The longer price remains below depressed levels relative to this cost basis, the more distorted the market becomes, and eventually that imbalance corrects. But what's fascinating is that this roughly 200-day mark has emerged as such a reliable signal of full capitulation in the past. And if you want to see every chart that I use, including the ones I'm using today, then go check them all out at onchainmind.io. Now there's one additional level that's also important, and that's the 100-day mark. Historically, this has been another major turning point where short-term holders begin to capitulate, not necessarily marking the ultimate bottom, but often producing at least a meaningful relief rally. And in many cases, Bitcoin either rallies after 100 days of capitulation or after around 200 days, depending on the severity of the drawdown. And my simple mind loves how these are round numbers too. So what we can see here is, in milder bear markets or mid-cycle corrections, the 100-day threshold has often been enough to exhaust sellers. And in deeper, more prolonged bear markets, the pain always extends closer to the 200-day level. So when we apply this framework to where we are today, the picture definitely becomes clearer. Right now, Bitcoin has spent 84 consecutive days below the short-term holder realised price. And to me, that leaves us with 2 primary scenarios. The first scenario is that we experience a 100-day style capitulation event. And if that's the case, then in roughly another 15 days, or about 2 weeks, we'd expect the market to begin rallying again. And that would put a potential turning point into early February. But the second scenario is that the downturn deepens into something more severe, pushing us closer to that historical 200-day mark. And if that happens, we could be looking at another 4 months or so of downward or sideways price action before a proper recovery begins. Now, personally, when I look at historical context, I lean towards the first scenario, and the reason for that becomes clearer when we look at 2019. In 2019, Bitcoin experienced what I would call a mini bear market. It lasted around 110 days to be precise. And if you were around at that time, you'll remember that this wasn't a euphoric blow off top, followed by a huge crash. It was a slow bleed. Price topped gradually, sentiment eroded slowly, and confidence faded over time. And that structure is very similar to what we've seen in the current cycle. This cycle didn't end in mania. It ended in distribution and ultimately exhaustion. And what followed that 2019 capitulation was critical. Once the market completed that roughly 100-day period of pain, it translated into a liquidity-fueled, euphoric end to the main part of the cycle. The recovery wasn't subtle, it was aggressive. So when I overlay that behaviour onto this current macro backdrop, I think it's a very valid scenario. Liquidity conditions are definitely improving, the macro dynamics are definitely shifting, and markets tend to front-run these changes well before they're obvious in the headlines. So in this scenario, we're likely looking at another 2 to 3 weeks of negative price action. That would take us towards that 100-day capitulation threshold. And at that point, we'd expect price to rally back above the short-term holder realised price. But from there, it's unlikely to be straight up. Historically, price tends to chop around that level for a bit as we tend to find our footing. The market needs time to rebuild confidence, and short-term holders need to regain profitability again and for sentiment to stabilise. But once that process completes, the conditions are in place for a sustained rally. And if the macro conditions continue to improve, that rally could extend well into the rest of 2026, driven by renewed liquidity and a more favourable economic backdrop. So rather than guessing tops and bottoms emotionally, this framework gives us something far more valuable, which is context. It tells us where we are in the psychological life cycle of the market. And right now, based on the data, we're much closer to exhaustion than most people realise. And even though the market structure evolves and new participants enter every cycle, the human brain certainly doesn't. Regardless of how complex the market becomes, people still react to pressure in very similar ways, which is why these time-based capitulation patterns keep just showing up in the data. So hopefully this gives you a clearer framework for thinking about where we are in the cycle, not in terms of emotion, but in terms of human behaviour and probabilities as the phase of this cycle continues to play out.